Well, thanks so much for tuning in to this conversation. We're just doing one markets conversation in the day. The budget was a short one. We're doing a short conversation with two guests, amongst my favorites, to decode what the finance minister said. And to be honest, based on all that I've read thus far, there are very little mysteries or surprises left by the finance minister. But for maybe some conversation around crypto, I don't know if Prateek or Saurabh would want to talk about that, but let me get them in this conversation to at least talk about what the basics of the budget look like. Gentlemen, both of you, thanks for joining in. Saurabh, the math, does it confound you or is pretty straightforward? And did it take you by surprise at all, either the fiscal deficit number or the push to capex?
No, I think broadly along the expected lines. If I had to sort of choose three relatively mild surprises, the government hiking capex by more like 40%, 35 to 40%, as opposed to my expectation of around 19-20%. So big jump in capex seems to be heavily centric on roads, which is a good thing. Second area, no extra taxes on the rich. Pleasantly surprised by that, very relieved as well. And instead, a relief on LTCGT for startups and on real estate. Good to see that suggests a degree of maturity about going after about taxing the rich. And the third area was taxing cryptos at 30%. I think that's a good development. It sends an unequivocal message to the public that cryptos are here to be taxed. Relieved to see a budget which is no nonsense, no faltu pronouncements, no faltu ka drama, focused on the money. 6.4% fiscal deficit for FY23, I think, is a believable number. The maths look realistic.
Prateek, would you say that too? Realistic? Because 6.4 is arguably on the higher side from what most people anticipated, but based on the current pulls and pressures, it's not a wishful thinking number, at least.
No, it is not wishful. I would believe that they penciled in a growth number which is lower than what the economic survey pointed out. A lot of the gaps would be filled by inflation, 8.5% real GDP growth plus inflation. And putting a finger on inflation number is difficult. So I think the numbers are realistic. We should get the numbers, very high probability that we will get there.
Prateek, it does anything around the CAD, etc., worry you at all? I mean, there is, of course, one school of thought which does believe that if you add the state deficit number as well, then CAD tends to trend higher for FY23. Is that something that you believe as well? Is that a cause for worry at all, or do you think the markets will take it in their stride?
No, you are talking CAD, current account deficit.
Yes.
Deficit, after being in the positive for last 2 years, turned negative in 22, will turn further negative in 23. Now, the point is, earlier it used to cause a lot of concern because software, if I take one of our largest exports, were a small fraction of the oil imports that we made. But now what has happened is software exports and oil imports are nearly similar. And software exports are growing very, very strongly. So, yes, in a year, we can have a current account deficit, but chances are we will make it over the next year or so. So the concern on how do we finance, do we again go out, do a India bond kind of stuff, that kind of thing is not there. So that is a relief, and it will be even better if oil prices get lower after the all the geopolitical tensions which are there get addressed.
Sort of just one quick macro before we come to the themes as well. The divestment numbers or the divestment receipts, both for the current year as well as the next year, are not very Herculean. I mean, they're fairly average numbers, and the capex push is fairly high. I didn't see too many of the other budget expenditures being laid out that much, but do you reckon the government is banking on the tax receipts being buoyant enough for being able to finance all of the things mentioned?
So I don't think the assumptions are heroic. So I think first off, I think the finance minister I reckon has been very smart by not baking in another tranche of LIC IPO money. I think there's some baked in this year, but I don't think they have baked in another tranche of LIC IPO money, which I think is very gettable. LIC IPO, I think, will see decent demand. So they've been smart because if the government commits to a punchy disinvestment number, they get forced into a corner, and I think they've tried to avoid that. But that apart, I don't think the fiscal maths is particularly aggressive. So, basis roughly what I calculated, government's total expenditure goes up, say 11-12%, and to get to a 6.4% fiscal deficit, we are banking on receipts going up 13%. Nominal GDP growth over the next 12 months should be anywhere between 12 to 13%. So I'm not so sure why people are worried about the 6.4% deficit target. I think it looks gettable. The maths looks conservative, and that's without taking into account further tranches of LIC being sold in the next fiscal.
Saurabh, would you say therefore that the budget has come and gone? The focus shifts back to the normal worries or the normal factors that one should be watching out for, and therefore any changes to your how do I say either the internals or the overall market assessment pre and post budget?
Look, we're a free market economy now. The government accounts for merely 15% of GDP. We have long been now a free market economy. The budget is of ephemeral interest. Nicely put. I think it's come and gone. The main thing to focus on is it looks like we're in the middle of the strongest economic recovery in the last 15, 20 years, driven by a mixture of a global boom in technology and in IT services, driven by limited extent government capex, and driven by the post-COVID unlock as we gradually come out of COVID and the hammering that COVID inflicted on the country gradually unwinds. I think we are in for a good 2 to 3 years of solid economic growth. Focus on that, invest into that. Don't focus on day-to-day stuff like what's happened this morning, this afternoon. It's gone. It was solid. Good job by the FM. Let's focus on making money by investing in high-class companies.
Okay, I think both of you are proponents of that. Prateek, same question to you. And part two of that question rolled into it. The near term has a couple of other, how do I say, event-based challenges in terms of one, the political calendar being what it is, and two, the fact that the global markets will not have the same Fed to contend with as it has for the last 24 months. How do you look at the markets therefore?
So one, agree with what Saurabh was saying, that budgets need to be an exercise in continuity and not a disruptive event. I like this about this budget. It is an exercise in continuity. A lot of steps were taken in the past few budgets, and they will continue giving the economy much needed fillip. In terms of overall market and market themes, the budget can do only as much, because if you look at it, the spend on capex is between 2 and 3% of GDP. However, more funds you put there, it moves the needle very little. So beyond a few days, it becomes whatever themes you were already focused on, they again start to take center stage, which is what we believe will happen this time again. Overall, in terms of market direction, I would say we are a tad expensive on valuations. We are looking at 15 to 17% kind of EPS growth in 23 over 22, and penciling in a positive market, but a tad lower than the earnings growth to build in some amount of valuation correction. This view is supported by the fact that versus earlier, when the growth spaces used to deliver most of the earnings growth, now it is also more of the commodity spaces which are delivering earnings growth. They command lower PE in terms of valuations, and hence, for people who are focused on PE-based valuations, they will seemingly come down on the index over the next few years. That's my thesis.
Okay, just a couple of things before we wrap up. Prateek, final question to you. From amongst the things that they spoke about, and not too much sectorally, but aside of capex, the domestic procurement for defense seemed to find emphasis in the speech. Was it noteworthy or pretty much something that was expected?
So they have already set the path. the direction is very clear. The extent of commitment is clearly noteworthy. From a 51% to a 68% is a large jump. So I would say that is a pretty solid commitment. I think good for businesses focused on that space. Once again, I will say this is an exercise in continuity. Lot of things which were started are continuing, gaining momentum as they should as we go deeper. It is not like you start so many schemes, waste your energies. It is very much like you stay focused, do what you have already started well.
Got it. Saurabh, final question to you. And one is, of course, any change in the thesis pre-post budget? I kind of partly asked that to you. And two, just trying to for people to understand, because there's so much of focus on domestic themes, capex, defense, so on and so forth. Would you believe the next 12 to 18 to 24 months, on a relative basis, belong more to domestic-oriented companies, or would you believe the global focus, export-oriented themes stand to gain better because of China Plus One, what have you?
I think, look, the global and the local are intertwined very strongly. So it's the three themes that we invest a lot of money in, and I also disclaim here that I also am heavily invested via Marcellus in these three themes. We invested heavily in top quality lenders. The budget should help with the capex recovery, with an economic recovery. Strong private sector lenders will do well. The public sector lenders are losing market share hand over fist every year. The FIIs are very enthusiastic about this theme. Some of our own foreign investor clients are going to invest very heavily in private sector banks. So global money, Indian banks do well. Secondly, building materials companies, we are heavy investors in that space, in paints, in pipes, and again, the infrastructure recovery, the real estate recovery should bode well there. And thirdly, IT services, right? India is the software programming capital of the world. The world's largest companies, the Fortune 500, are heavily digitizing. The Indian IT services giants are up to their noses in work. I think we're looking at probably 2 to 3 lakh jobs each year being created for the next 2 to 3 years. The FIIs are investing in the Indian IT services themes. So I think that era of thinking local and हमारे देश में क्या होगा, it's all very well, but it's now global capital investing in India, Indian companies serving the needs of the world. And the good news for those watching is that entire picture bodes well for India. It's a strong domestic recovery, a very high foreign investing in India. Government's been positive about startups, given relief to startups. Expect to see more global money flooding into Indian startups as well.
Okay. Jaiman, thank you so much for your time. Really appreciate and giving us a quick synopsis. It was a short budget speech, and I'm glad we are able to wrap up basics in this short video as well. Thank you so much.
Thank you.